All right, folks, we're going to talk a little bit about the world of private credit. It has ballooned, by the way, to about $1.7 trillion in size in just a matter of years. There's a lot of issues going on in this environment. Most loans held in private credit funds mature within 5 to 7 years. It's a time frame for when investors should start seeing many more returns, but many vehicles formed 8 years ago still lagging on a closely watched metric known as distribution to paid-in capital, which measures how much investors have received compared to what they put in originally. We're curious what our next guest has to say. He is a player in the private credit world. Mark Gatto is co-founder, co-president, and co-CEO of Scion Investments, which specializes in alternative assets, in particular private credit or private debt. The firm has about $10 billion in assets under management. Mark is also director, co-CEO, and investment allocation committee member of the Scion Ares Diversified Credit Fund. So you know a little bit about credit. How are you? Tell us a little bit about your fund and the strategy right now.
I'm doing well. Thank you for having me today. So our platform is really focused on providing alternative investment solutions to private wealth investors, individual investors. So where a lot of the private firms, private asset managers that deal in private credit and other strategies focus on institutional clients, our focus is on individuals, and we distribute our products through the wealth channel, the RIAs, the wirehouses, independent broker-dealers. We currently have 3 products that we're very proud of. One is our publicly listed BDC, which is called Scion Investment Corp., and that's a strategy where we focus on the U.S. middle market, providing direct lending, private loans to U.S. middle market companies. We also have a diversified credit fund, and that's a partnership that we have with Ares Management, one of the world's largest global investors, top tier in credit, and that fund is structured as an interval fund. And we have close to $8 billion of AUM in that product.
So that's the big one.
That's the big one. That's the big one. And then we just recently launched, it's not private credit, but it's private assets, private markets. We launched an interval fund that focuses on infrastructure investing. So we are all in on private markets, but we're also very focused on the right structures for the individual investor. The stat that you mentioned earlier about capital effectively being locked up, right? That's not what we do. We really focus on strategies that provide appropriate liquidity to individual investors. Where traditional private credit was done in a GP, LP drawdown structure, and your capital could be locked up for a long time. And because of these structures, we're seeing this strong demand by registered investment advisors, other financial advisors that deal with individuals, and that's what these products really are doing. They're opening the gate, right? They're providing the access that individuals have never had.
The growth of private credit over the last few years has coincided with a pretty strong economy, and we're now starting to see some cracks form. We saw the revisions downward with the labor numbers that we got today. Jamie Dimon telling CNBC today that the economy is, quote, weakening. He said, whether that is on the way to recession or just weakening, I don't know. What happens to private credit in an environment that's weakening, an economy that's weakening?
Your strategy specifically.
So I think that obviously there'll be some winners and losers, but I don't think the market craters. So it's really important to tie yourself to a good manager, someone that is very experienced in the industry, knows how to underwrite, knows how to be selective, can generate opportunities that make sense for the investor.
Well, because the concern is that the folks who have been lent money will not be able to pay that money back.
Yeah, and that's been a theme that's going on for some time now, right? We've been having this conversation for a long time, and people got really spooked when interest rates spiked, and how are these companies going to afford their debt payments? And the reality is that they have been able to do it. And I think a lot of the U.S. middle market is very resilient. And when you think about the assets that we focus on in our publicly traded BDC, we're looking at companies that are between $25 and $75 million of EBITDA, which we believe is the true middle market. What's happening now is there's a real convergence of the syndicated loan market where banks typically played, right, and the upper middle market. So private investment managers, private credit managers are doing those deals that banks used to, and I think that's where you're going to see some more issues.
Why are the banks not doing loans to those companies? Or conversely, why are those companies not going to a traditional bank for that loan?
Sure. So effectively, banks have been regulated out of the business, right? They're not focused on it. They abandoned the business after the great financial crisis. They let all of their deal team go, all of their portfolio managers go. They were gobbled up or formed their own private asset management firms. So you don't see see the big banks doing these types of deals because they just don't have the expertise anymore. What they do is they get involved, I think, in the market more synthetically by lending to firms like us, where they can be on a more senior secured position. And what we're seeing is these larger private institutional asset managers, they're getting so big where they are now the bank. The difference is that the investment committee, the people making decisions there, are able to do it more efficiently, provide more certainty, be more flexible than, say, a traditional money center bank.
We're talking with Mark Gatto. He is co-founder, co-president, and co-CEO of Sign-On Investments. Mark, what's a deal you will do in the private credit space? What's a deal you will not do? Because, and how much transparency are you feeling like you're getting on these deals?
So we feel like we get a lot of good information. Obviously, We're very diligent about doing our underwriting and understanding what we're getting ourselves into. I think every investment warrants merit if it meets some of our baseline criteria, right? So we're looking at companies that have earnings, right? So that's first and foremost. So $25 to $75 million EBITDA is our sweet spot, and then we want to really focus on: Are they relevant in their industry? Are they a leader in their industry? Do they have a good management team? Is there a reason for them to exist? So we're gonna focus on those things to determine whether or not we want to do the deal. On a high level, we're not doing a lot of stuff that's very cyclical in the BDC and even in our interval fund diversified credit. We're not doing cyclical industries. We're probably staying clear of retail in many instances. Not to say that we won't do either of those deals.
Right.
It's just not going to be a major portion of what we do.
Give us an idea of a deal you recently did. And I'm curious about the infrastructure play right now, if that's a big part of it, or energy, what you're seeing.
Yeah, so on the infrastructure side, which is a little bit different because we're actually focused more on the equity of these infrastructure deals. So, but they do have a lot of characteristics that credit assets have. I think it kind of falls in between pure credit and private equity, if you will, right? Because when we're talking about infrastructure, we're talking about revenue that's being generated by these assets. So it has that element, but there is some sort of growth story to that. And if you look at our infrastructure fund, we're doing deals like the M25 in London. So roads, bridges, we have terminals at LaGuardia, terminals at JFK. We're in AI and data storage. So we really run a diversified strategy, and that is a theme throughout all of our products. We want to be diversified, and we think that's probably the most important thing for us as a manager, and we think for investors is to be diversified. If you look at our BDC, we have 160 different names in there. If you look at our interval fund, the Sign Ares Diversified Credit Fund, we have over 700 names in there. So you're really getting granular, you're really getting diversified. So no one deal is going to make a difference, and no group of deals is going to make a difference. And we're doing that same thing with infrastructure. We want to be highly diversified.
Is there political risk with the infrastructure fund in the sense that you have an administration right now that wants to punish different states and cities for not getting in line, essentially? We see that with the Trump administration and with the MTA, for example, and tolling, congestion tolling. Is that a risk?
So we don't view it as a risk because of our diversification, because we are investing in different areas of infrastructure. We're not a clean energy play. We're not a fossil fuel play. We don't believe that there's much political risk in terms of our strategy. And then if you look at the industry as a whole, the market as a whole, there's such a high demand for infrastructure assets. There's such a need to spend capital to improve our infrastructure assets, not only here in the United States, but globally. It's a multi-trillion dollar opportunity. We don't think that the current administration or a new administration is going to sort of move the needle one way or the other, especially if you're diversified. And again, I go back to that theme. It's really important at Sign Investments. We preach it to our advisors and clients that's where you need to be, not only within alternatives, but across the entire spectrum.
Just got 30 seconds. How would you describe the environment? In a word, a couple words.
I think the word that describes the environment is uncertain. It's been that way for a while. It's going to be that way for a long time. Information moves too quickly. The global economies are too interconnected. There's always a news story that's going to give you some sort of angst that's going to make you think things are uncertain. So that's why we fall back to diversification, and we like alternatives for our clients, our advisors, because we think we stabilize some of that uncertainty and volatility in the marketplace.
We know you're based on the West Coast, but we hope we can attract you back to our New York studio.
We're headquartered in New York, so anytime I'm there often, anytime you would like to have me on as a guest, it'd be my pleasure.
We would love it. Mark Gatto, he's co-founder, co-president, and co-CEO of Scion Investments.
This is the Bloomberg Business Week Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.